Greg, remind me, what is it next week? CPI? Any other top-level data?
We have retail sales as well next week. So it's a busy week in terms of the direction of travel of consumer spending as well as inflation. Two very important elements for the Fed. As you noted earlier, we are in this uncertain environment where I think both investors and policymakers were hypnotized by this Goldilocks economy, where most were expecting things to remain fairly steady. And what we learned after the payrolls report and the Fed meeting is that the economy is indeed weakening, as we've been highlighting for a time now, and the Fed is likely behind the curve when it comes to easing monetary policy, given expected economic conditions.
Chad, do you think they're behind the curve? To what extent do you expect them to play catch up? And what should we make of market positioning?
So I don't believe that the Federal Reserve is really behind the curve. They're getting what they wanted. So they're in the catbird seat. They had that inversion of the yield curve. There's a deceleration or moderation of high-frequency data points that are coming out. You're hearing from earnings, particularly in June and July, that there has been a material slowdown. And now the Federal Reserve will do what the Federal Reserve has typically done throughout history, which is start to lower interest rates. September will be the launch of it, 50 basis points perhaps 25 overall. And next week, what we're going to focus on is the initial jobless claims, the CPI, and of course that PPI. The inflation numbers are cooling. They're getting what they wanted.
What kinds of stocks, Chad, should I be looking at in this kind of environment? It feels as though some of those Mag 7 stocks are a little wobbly again. I mean, you've got NVIDIA, and we'll have earnings from them within the next couple of weeks. But there are a lot of them out there that feel maybe a little vulnerable. Should I be looking elsewhere if I've got fresh money to put to work?
Yeah, thank you for that. Yes, actually, you're going to see a broadening out of many of the higher quality, lower volatility names now participate within the market as you see the deceleration of the U.S. economy. So we would look at consumer staple companies, healthcare companies, and two to look at as well are Elevance as well as Pepsi, two high-quality companies, growing, profitable, well-capitalized, lower volatility names.
Greg, as we ponder that, I wonder what you would tell us. You mentioned you think the Fed's behind the curve, but does that mean you think the data is going to weaken, or just that you think inflation is giving them room to cut?
I think both are likely the case, Kelly. I think we have an environment where there's ongoing disinflation momentum. Consumer spending has been slowing for some time now. Disposable income growth is only 1%. That's going to drag consumer spending lower. You have less markup ability from businesses. You have more pricing sensitivity. You have declining wage growth, and you have a strong productivity environment. These are all disinflationary. But the direction of travel of the economy is really what's most concerning for me. We're seeing that the labor market is similar to that of 2019, but we're coming in a different trajectory with a slowing of labor market developments. I'll note one thing to highlight why the Fed, I believe, is behind the curve. If you look at their latest summary of economic projections for the end of 2025, they have an unemployment rate at 4.2%, they have inflation at 2.3%, and they have a Fed funds rate at 4.1%. Look at today's economic conditions. The unemployment rate is at 4.3 already, inflation's around 2.5, and the Fed funds rate is still at 5.4. That means that the delta in terms of real interest rates is around 120 basis points, which would give the Fed the leeway to ease monetary policy. I don't think they will do that, but that's the type of gap we're looking at in terms of monetary policy being excessively restrictive.
In other words, you don't think they'll go all the way down to that level, or that they won't make changes at all?
That they'll be more gradual. We're not going to see a rapid reversal in their approach to policymaking. We've said for a while now that the Fed has been excessively backward-looking and data-dependent. They don't have, in my opinion, a sufficiently forward-looking framework to analyze current economic conditions and expected conditions in 6 months, 12 months' time. And unless we start to see the Fed reclaim control of the narrative and adopt more of that forward-looking perspective, the Fed is likely to remain behind the curve for some time. Fed Chair Powell will have an opportunity at the Jackson Hole Symposium to regain control of that narrative and perhaps propose a forward-looking perspective.